Good afternoon and welcome to the CQS Natural Resources Growth and Income PLC Investor Update. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Fund Manager Rob Crayford. Good afternoon to you, sir.
Thank you. Thank you very much. Thanks for the introduction. So obviously there's probably different levels of understanding on the fund. So apologies for those of you that may know us in a bit more detail, because I'm going to kind of run through the basics. It'll be fairly high level, but there'll obviously be time for questions at the end, and we're very happy to field any of those. So CQS Natural Resources, growth and income. So I'll kind of run through some of the high level basics. I'll kind of flick through relatively quickly. It's got over 100 holdings, but is fairly concentrated. So you can kind of see there in the top 10. So obviously within that you have a bit of a larger tail, but very much a sort of conviction style fund in its larger positions. It's currently heavily weighted towards energy. You can see that with oil and gas being the largest weighting. We'll touch on some of the fundamentals there, which we think are very attractive and provide an attractive investment, certainly on a risk reward perspective going forward. We've got a sizable gold position and precious metals larger, including silver and PGMs, and shipping and other sectors as well, which we'll touch on in a bit more detail. Also, just to note, we pay a dividend as well, so current yield is around 3.4%. Bit of a quick background. I know as Keith and I are the co-managers, so both on the call here. Ian Francis, or Franco as he's better known, is head of the team, also a fund manager, but he also manages the UCT High Yield Fund, so he's more focused on the credit side, which isn't part of this fund anymore. If we move on to performance, so performance has been strong. As you can see here, we sort of materially outperformed over the last. This is a 5-year chart, but you can see here versus MSCI World Mining and MSCI World Energy. We think they're sort of clearest benchmarks, although this fund does have a high level of flexibility, so you can switch between energy or mining wherever we think there is the best investment opportunity, or certainly on a risk reward perspective, and we'll talk through that in a little bit more detail. So key themes that we're sort of trying to gain exposure, or we're trying to provide exposure to for investors. So protection against inflation. Commodities clearly are one of the best sectors there for protection against that. General underinvestment in the sector overall, so ESG focus, general emissions focus, and restrictions from government has really limited and constrained supply, as well as further discipline and constrained management teams with capital discipline within management teams. And then the energy transition, which kind of overlays to general GDP growth, but it also adds incremental demand in the form of copper, lithium, etc., which we'll touch on as well. So sector breakdown, kind of touching on that again. I mean, you can see it's fairly diverse. We do have that flexibility, as we touched on, and region-wise, heavily weighted towards North America, but it's very much a global fund. So whilst we are listed in the UK, we don't have many UK listed names. So predominantly listed in Canada and the US and Australia, given that's where most of them are focused. Again, flicking through quickly, I mean, top 10 here, you can see on that kind of concentration focus we were talking to, and conviction. The majority of these are energy weighted, or at least energy proxies. So you can see here number 2, BWLPG is a shipping company focused on propane shipping out the US. Transocean is oil and gas drilling. Precision is onshore oil and gas drilling. And then we kind of move down further producers within Diamondback and Vermilion on the oil and gas side. Frontline, another shipper. EOG, another producer, and Diversified, another producer as well. The only ones that aren't energy here are NextGen, which is a uranium mine, which is currently a developer, kind of moving through the final stages of permitting, arguably energy, but we'll kind of touch on that a bit later on. And Emerald Resources, which is a gold producer with assets in Cambodia and Australia, just to give a bit of colour. These are all sizable companies. All but one are north of $1 billion, just to put that in perspective. So, whilst we are, we do market the fund as being able to play in that kind of smaller cap sector. This is kind of done on a global scale and not the kind of micro cap that we see in the London Stock Exchange. So like some of the LSE smaller LSE names. Commodities overall, generally perform well during periods of reflation and stagflation. We note there, so gold especially does perform well during stagflation. We're now seeing that where inflation is now starting to soften, but there are questions there about how persistent that remains. Certainly, we all feel it personally, even if we are starting to see pockets of deflationary pressure starting to feed through. We still see some way off that, and remains one of the biggest questions in financial markets, which I'm happy to address later because it's a bit of a big topic to try and address. So key themes. We kind of believe the energy crisis that we saw last winter. We still think there's scope for that to reoccur, but at the moment kind of feels far more comfortable with gas storage at record highs. But ultimately, we think there is scope for reoccurrences of that kind of incident, but not necessarily to the same scale. But ultimately, it's down to constrained supply and demand continuing to grow with GDP. So, general global policy focused by governments, focused by investors. So big pension funds are heavily pressuring the likes of BP, Shell, etc., to reduce emissions and ultimately reduce production. So it's pressure there that's seeing a lack of supply growth, even as we see continued demand growth out of the likes of India, Indonesia, Philippines, growing emerging markets. And this is one of the key reasons we have a heavy focus to it. So it's top down. We like the constrained supply, continuing demand growth, but also because of that ESG policy from the investment side, the names are actually incredibly attractively valued, where we're getting very high free cash flow yields, and they trade at a discount to their net asset value. So yes, as we touched on, large component of the fund. Top right chart here just sort of talks to declining inventories that we're seeing globally, and continued growth expectations here down in the bottom right for demand, which doesn't tally with the lack of supply growth that we're seeing. If we look globally, the majority of supply growth came from the US, where now, if we flick onto the next slide, we have a chart here looking at the WTI, so US oil price in the light blue. In dark blue, we've got US land rigs. And what we can see is, even though we're seeing stronger pricing, we're seeing very little response from the producers to start to ramp up production. And the US has been the major swing component to incremental supply. So this is a big factor for oil supply and demand balances. So moving forward, we think the US is getting closer towards a peak level of production out of the US onshore producers, and as a result, going forward, it's becoming more uncertain about where that incremental supply will come from. As we speak, we currently have OPEC meetings going on, but it's not entirely clear. There's a few small pockets like Guyana, some parts off Africa, more of a focus towards LNG, etc. But ultimately, we still believe there's going to be a place for oil, and we think with the attractive valuations, that provides a very attractive risk reward on those names that we're focused on within the fund. I'll pass over to Keith.
Thanks very much. We do like the energy sector. It is one which is probably less susceptible to rather more muted overall growth than is perhaps the case with the mining sector, though we like the outlook for the resources markets generally overall because of the underinvestment that we've seen. One that particularly stands out is uranium. Post Fukushima, that's been in a decade-long bear market, and as this chart indicates, we're in a supply shortfall of raw feedstock for the industry, which fits perfectly into government policy to deliver affordable baseload power to provide stability to the grid, which is increasingly unstable because of some aspects of intermittent renewables, as the only carbon-free baseload power generation. In particular, we've seen the price rise, but one of the crucial factors of this commodity, as opposed to, say, fossil fuel-powered energy generation, is that it forms a very small proportion of the overall cost of producing fuel. So even at $80 a pound, which is up nearly double over a year, it still only represents a single-digit proportion of the cost of producing power versus, say, gas at nearly 2/3 or more of the cost of electricity. And policy has really seen a sea change in attitudes from the situation we saw post-Fukushima. I mean, if we look at COP28, it's a prime example where the US is leading an alliance of established nuclear producing markets of the UK, France, South Korea, Sweden even, to try and triple nuclear generating capacity over the period to 2050. We've got the WNA, which is one of the industry monitors, saying that we'll see by the end of the decade a 30% increase in requirements for uranium. So this is something which is going to see much improved investment horizon, and for that reason we have seen a significant improvement in performance of the uranium exposure, such as Developer NextGen, which is a strategically important asset globally. But we still think we've got much more room for maneuver on that. So we'll be keeping a very good percentage exposure of the fund in that sector. We're still very cognizant of the energy transition. I think, though, there has just been a more realistic assessment of the pace with which that will take place. I think it was unreasonable before that transition at any cost would be easily fulfilled. And I would say that for preference, we prefer those commodities which are perhaps less technology dependent. Copper as the delivery mechanism, we've still got that exposure to the actual raw electrons, whether that's via gas or oil, as Rob outlined earlier. But we have liked lithium in the past. For the moment, though, we've seen a sharp correction in the price as a result of some short-term, perhaps just temporary, reduction in the pace with which EVs are able to grow their share in the market. And for that reason, I'd say that our lithium exposure is smaller than it has been otherwise, as indeed is copper slightly, because we just have a relatively stronger bias towards the energy sector. But nevertheless, this is a sector which is going to benefit over the longer term, and so we retain some small exposure to these types of elements. Another factor which we're very cognizant of at the moment, and it refers back to the earlier slide that Rob referred to, is that disinflation is occurring, but from a level of high inflation, and actually the growth outlook in terms of aggregate demand and GDP isn't that strong, even with some stimulus that we've latterly seen in areas such as China. Behind that, we've seen a huge increase in global debt. If we just look at the US, we've seen something like the 33 trillion of liabilities are currently accumulated, and that is up over the last year from 31. And if we look forward at the interest rate outlook that is currently discounted, we'll be looking at something like a 5% average for next year, rather than the 3% that is currently assumed to be applied to that, which will mean that in the next 3 years, something like $1.5 trillion worth of treasuries will need to be issued just to pay the interest on those liabilities. Against that, China has started to really reassess its relationship with the US dollar and has started to de-emphasize its exposure to US treasuries and instead is actually buying gold. And that's a key theme that we see across most central banks, in fact, that they're all adding to their gold inventory as a reserve. We had a temporary pullback in the financial sector's exposure to the sector. That typically happens when interest rate expectations rise. But now that that is actually backing off, we have latterly seen in the last couple of weeks ETFs start to reaccumulate, and they have been very much a marginal buyer and price setter of the gold market. And for that reason, we've got a probably one of the higher precious metal exposures that we've had, because we see it as cheap insurance. If we were to look at some of the valuations of the equities in this sector, they are as depressed when viewed on a price to net asset value at spot gold prices as they have ever been, whilst Rob and I have been running this fund over the last 10 or so years. And this chart really just indicates that if we look at some of the less liquid investments, particularly the developers and the explorers, they're almost tempting us in. I would say generally we have concentrated on producers, but one of the assets of owning a closed-end fund such as this is that we're able to take positions in some of the less liquid investment opportunities that are out there, and they have by far the better attractive valuations. So we are tentatively sticking our toe, generally actually in the sector, in some of the less liquid names that have just been utterly ignored by the market. And gold is one of those which, despite the strong gold price, even in dollar terms, it's at record highs in pretty much every other currency. And for that reason, as I say, we'll maintain a good exposure to it. Base metals are in there. This includes copper, also a bit of nickel, as we referred to earlier on the transition metals. And as I outlined then, I'd say for choice, we would rather not go for technology dependent specific elements. We would rather just go for the delivery mechanisms or the bottleneck in supplying responsibly sourced electrons to fulfill this energy transition. This is probably the lowest exposure that we've had, and I would say that part of the reason behind this is that the growth outlook for aggregate demand, and in particular things like the domestic Chinese demand in the property sector, which still accounts for some 20 to 25% of overall copper units consumed, is not the healthiest that we've seen it. The chart at the bottom left there shows new starts in orange, and we've pushed that forward a couple of years, and we measure it against housing completions to show the likely trajectory of those completions over the next year or two. And that really does act as a bit of a headwind, I think, for the base metals and industrial metals in particular. And one sector that we don't really talk about is iron ore. We think that that one, which for one point doesn't really have much cost curve support. You know, the cost of producing from the big cartel is you know, it's $40 a ton versus the current prices, which are way above 100, is also a noticeable absence in the portfolio. We'd rather not be exposed to that. You can get that exposure yourselves more directly and probably cost effectively just by owning BHP or Rio Tinto, should you want it alongside this fund. But there will be that incremental drag to prospective copper demand in the short term. If we look at shipping, this is a sector that we like as, again, kind of a delivery mechanism for energy around the world. And one of the key reasons for owning this is, again, back to the underinvestment that is a theme right across the resources market. It's very difficult to get finance. And this chart shows you the future order book for new build vessels, which is at all-time lows. There are many reasons behind that, much of which is to do with propulsion units and whether or not these will be clarified. But most financial institutions don't want to lend to this industry. And as a result, the day rates that this sector is able to command have been moving up quite smartly. And this is actually one of the sectors that's contributed quite significantly to the overall revenue and income for this fund, which we've been able to distribute. The outlook remains strong on earnings, and we expect the dividend payability from this sector to similarly follow suit. Shall I hand back to you, Rob, to do a conclusion?
Yeah, look, you know, we can touch the different sectors, but I think there are some overriding themes, and that's general, you know, lack of investment into them. Whether it's the sectors overall have kind of been in an extended bear market before, kind of into that sort of 2015 period, and then they had a real shift in management teams and a real focus on capital return. So, rather than investing in new supply, companies are now paying more dividends, focusing on buybacks. That's certainly at the sort of BHP Rio scale and below. But then, as you work down the sort of market caps and you get to some of the smaller projects, that's kind of leaving, more of a gap, a supply gap that ultimately needs filling. They've underinvested in exploration in general, so they do need to acquire for they do need to acquire to kind of fill their pipeline. So that kind of gives a bit of an extra M&A theme. But ultimately, it's that constrained supply. We're still quite constructive around demand, although having ultimate caution around potential fallout of China following the property sector issues that we're seeing, which happy to talk to in more detail if people have any questions around that. But ultimately, we think we're in this kind of artificial market that is artificially constrained on the supply side, yet demand continues to grow, and that leaves us with sort of outsized opportunities to generate superior returns over the medium term. Now, obviously, there will be periods of volatility within that, but we're kind of very constructive and think there's a good opportunity there as a sector for shareholders. And maybe we should move over to questions. Thank you.
Perfect. Rob, Keith, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. We have received questions while you've been presenting, so I'll kick off the Q&A session with this one here, which reads as follows. What macro trends do you foresee reshaping the current sector balance of the portfolio?
Well, I'm happy to start with that one. It's commodities. So
thank you very much.
Sorry, Keith, I'm getting feedback. You're joining me. It's commodities. So obviously it ties into all macro themes. But we touched on it there. I think if you go back a few years, we would have been very heavily overweight base metals and underweight energy. It's those shifts we kind of see, and I guess it's our concern around the Chinese property sector and fallout there, which has led to us having an effective underweight in the names. But that's on a top-down view. So I guess within portfolio construction, maybe that's a good point to touch on that. Portfolio construction is a mixture of top-down and bottom-up. So in the case of base metals, we have that kind of cautionary aspect there because of the Chinese property sector. So that's the top-down view, but on a bottom-up perspective, these names are very rich relative to energy names. So as a result, we have one of the smallest weights, or the smallest weight since Keith and I started running the fund 8 years ago. And then if we look to energy, the supply side is it's even more out of favor. The kind of fossil fuel industry is kind of viewed as relatively toxic, for the big sort of pension funds with real kind of ESG constraints, although we have seen that kind of shifting a bit more positive and a softening to that tone. But as a result, the top down has more supply constraint, and the bottom up, the names are very attractively valued, where 30% free cash flows on uncommon in some of the smaller names, and by smaller I mean around a sort of $1 billion type range.
And if I can ask or highlight another question that we've received, can you highlight the mispricing of smaller market caps? What market cap thresholds do we have? And I think that's quite a good one. We don't have any particular cut-off. In fact, we're fairly unconstrained as to where in the capital structure, where geographically we invest. And I would note, if I were to just jog back in the slide to the gold presentation, and this is perhaps useful for some clarity because it's quite a homogeneous sector. If we look at the lower line there, say that the purple line, that represents small cap developers, which often aren't fully funded into production. And we see these things trading at a big discount to the net asset value of the overall project. I'd say there are instances where there are some in the early stage development or late stage exploration which are trading at, say, 0.1 times PNAV, and they are unfunded. And almost universally ignored, and it's those that we are seeing some increased interest from us to perhaps invest in. Does that represent an opportunity? It certainly does. The reason it's an opportunity is because I think so many of the larger funds are unable to invest in them. Typically, we would like to think that we would wait for a potential capital raise. We're one of the few remaining closed-end companies that will look in this space. We meet hundreds of management through the year, or at least speak to them on screen as we are here, and that gives us a good barometer of where sentiment is and how difficult they're finding it to raise funds. And one of the advantages we then have is that we're able to purchase new issued units, which in many cases include a half warrant or a full warrant at a small premium, which give us extra leverage into the unlocking of a perceived overhang, which the financing answers. And so in answer, I think we are seeing increased opportunity in the less liquid, some might say smaller cap end of the spectrum. We've been slowly tempted into it. Some of these companies, such as Talon in the US, which is a nickel developer, has got big offtake contracts already signed with key customers such as Tesla. It's got free government funding from the US critical minerals avenues. It's got grants which are unencumbered and is pretty much fully funded without any requirement for equity, though we would always conservatively expect there to be some. And for that reason, it's one that we have been looking to add to, having taken a position some time ago. And I hope that gives you a flavour for the benefits of investing in this closed-end fund, which is trading at a discount.
Perfect. Thank you very much, Keith. Just turning to the next question, how does your ESG policy affect your investment decisions?
I can dive in on this one. Yeah, so we don't have any kind of strict ESG kind of policy constraints. The reality is we've actually been applying an effective ESG policy on all our names for decades. So, any mining company, it's been very important that they act within good operating standards, just to retain their license to continue to operate in that country. The worst thing they can do is through bad practices, end up seeing their mines forced to close down. And this has been a primary focus of ours purely in the investment strategy. So whether that's a mining company in West Africa, it's clear that it's got to have good buy-in from locals. It's got to have good water policy. It's got to have treat staff fairly. So yeah, and obviously good environmental policy, especially around tailings dams, etc. And that's similar across Latin America. That's similar across the West. So ultimately, it's Western standards being applied to even to emerging market locations. So yeah, from a bottom up view with our specific companies, it's something we would practice anyway. I think more important is actually this whole kind of ESG shift has actually created a lot of opportunities for our sector overall. I touched on it earlier, just around the policy impact that's had on constraining supply. At the same time, all policy has ultimately been focused on constraining supply, and the reality is actually demand isn't adjusting as quickly, and that's led to big disconnects. It was definitely something that had a material impact in exacerbating issues around the energy crisis. It just, it wasn't all Russia, Ukraine, and gas supply into Europe. There were sort of wider issues there as well, as coal plants and old, the sort of older style energy generation was kind of being closed, particularly in Europe, particularly in the West. And there was a real shift and a greater reliance there to gas and then renewables. And ultimately, renewables are a variable source of power. They are not base load. And Keith touched on it earlier with nuclear as being the only zero carbon form of base load. The reality is renewables are variable, and as a result, they need to have sufficient battery storage. So we kind of use it as a theme, and it does apply across many of our names. But as you can see, we do own things like thermal coal, which we have a smaller weighting to in there, and that was in as much due to firstly the investment opportunity it provided, because there was a real real lack of new supply, so generated very strong returns for the fund. But also, there's actually a strong ESG argument in providing this high grade thermal coal from the likes of South Africa or Australia. You're actually displacing the dirtier local coal that these countries would otherwise be burning. So energy security is a key focus across markets now. Whether that's China, emerging markets, and the West. So the reality is it is winding down some of some of the old economy kind of sources of energy, but it's going to take much longer, and it's going to take a lot longer than was initially expected. And we've seen a real sort of softening stance to that. We touched on it earlier with fossil fuel, oil and gas producers, where we're basically persecuted in the press as being, the worst of the worst, and we've really seen that rhetoric kind of shifting to being more supportive. There's greater understanding. Even ESG constrained funds, Article 8, etc., are now owning oil and gas names, as long as they're kind of seeing positive change. So, the big impact of it is it ultimately constrains supply. It improves the investment opportunity, but at the same time, we do have that kind of inherent overlay just in good practice for companies, because we think that makes them a better investment opportunity.
Perfect.
And I'll leave that there.
Yep, and I do think we are pragmatic. So we do have a top-down view, and we have a bottom-up assessment of the company and its cash flow, but we also try and read softer issues like sentiment. And as Rob said, I think there was a big shift in tack for our overall portfolio exposure to the traditional forms of energy in particular, when it felt that sentiment was at its absolute low ebb, which was around 2 years ago, COP26, when in 2019, 2020, we saw inventories of fuels run down across utilities to their lowest, and just an assumption that transition would take place at any cost. And I think it's actually a good thing that governments have actually sat back and taken some more rational decisions. But moving on to another question, there was one which I think is quite important for a commodity sector, and we're asked, what exposure to currency exchange risks do we have, and how are these managed? And I think it's quite important just to say that we don't typically hedge any of our currency risks. We have on occasion only hedged if we felt or had a strong view that, for example, the US dollar might shift appreciably against sterling if we wanted to lock in some dividend income, but it would only be on a short-term period for that dividend income. In general, we let these things wash through. And the one thing I would say is that it feels increasingly like having some real assets that are unencumbered, such as the resources sector. Maybe that includes gold, but generally real assets that are unencumbered, I think, will probably stand in good stead in the sort of stagflationary environment that we currently envisage in the near-term outlook.
Perfect. Thank you very much. We've got another question here. Is there potential for significant price increases in commodities, especially more traditional oil, etc., due to the lack of capital flowing into new projects and developments in recent years due to the net zero and energy transition policy?
Can I answer that one,
Yep.
Rob?
Yep.
I'd say the one that we still see, we suspect. I'd say that we do look at it slightly differently to just taking a view on the commodity price, which would probably have us going for the most operationally leveraged entities out there. I would say that on the oil price, this is a good price. What we see at the moment is that there is still pressure against the fossil fuels, and it's a market which seems to be managing supply very well in order to sustain price advantage. And I'd say in the oil market, OPEC Plus is taking a good lead in that respect, whether it's oil, but similarly in the gas markets. There are other commodities, and I mentioned uranium, where there is far less demand destruction from upward moves in the price, and despite it reaching, a 15-year high of over $80 a pound, previously it's been up to 140, and that is achievable again. We've seen, the lithium price just retreat from about $80,000 a ton of lithium carbonate down to something like a break even in lepidolite terms of about $15,000-16,000 a ton. At some stage that might recover, but for the time being we don't necessarily see that.
Perfect. Rob, Keith, thank you for that. I think you've addressed all those questions from investors, and of course the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Rob, could I just ask you for a few closing comments?
Yeah. So I mean, I think we've kind of fairly high level talked through the sectors. I mean, we're obviously very constructive on what we see going forward. We touched on those sort of primary drivers there. We think both top down the sectors look interesting. We think bottom up, the names, especially sort of in energy and certain other pockets, uranium, we think the valuations themselves look especially attractive as well. And we think there's a real shift there of that kind of ESG sort of anti-net sort of negative sentiment towards the sector, towards actually realizing that mining and energy is part of the solution towards that transition. So we're very constructive on the outlook. The fund continues to trade at a bit of a discount, so sort of circa 15% on this chart attached. So obviously that gives shareholders an opportunity to buy these names within the fund at a discount to the effective NAV. Clearly performance has been strong. We think there's further scope to continue to see that. Clearly there's going to be periods of volatility. There's definitely some elements of uncertainty in the world, but we think we've kind of the fairly diverse structure within the fund. You look to the sort of large precious metal weighting, etc., provide some protection against that, and you can kind of see that within the volatility. And I will leave that there. Thank you.
Perfect. Rob, Keith, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CQS Natural Resources Growth and Income PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.